Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra and I'm joined today by our global market specialists, VanderHorn and Oriane Parmentier. I think I've said this every week for like the last, I don't even know how many weeks we've been recording Bondcast, but my opening line was going to be that there's still plenty of headline tenors out of the Middle East, and it's still the kind of no deal narrative that's driving markets. I think markets still tend to lean optimistically. There's been kind of a renewed set of threats this week from President Trump as we're recording. There hasn't been enough yet to break out of the current ranges, I would say, in terms of where we've been trading. And there's certainly, I think, an element of headline fatigue as well. You know, we're seeing the market moves to every subsequent headline as sort of getting less, or certainly significantly less than just a few weeks ago. Away from that deal or no deal narrative, we've of course been very focused on the central banks this week. We're recording fresh off the ECB today on Thursday, and we have the Fed and the BOE next week. So perhaps it makes sense to start with the ECB, with you, Oriane. What would you say was the kind of key message from today's ECB meeting?
So the ECB delivered exactly what markets expected on the surface, I think, which is a clean, unanimous 25 basis point hike with no forward guidance. But when you look at the updated projections and Lagarde's tone, there was a hawkish tilt, I would say, mainly coming from slightly firmer core inflation forecast, but also a stronger emphasis on upside risks tied to this energy shock. What stood out to me is that the ECB sounded less concerned perhaps about growth than we had expected and much more focused on inflation risks. So Lagarde avoided to give any hints about timing. She didn't frame the next move as July versus September. And she didn't insist on needing a full new set of projection either. And I think that's important because it effectively keeps July on the table. So I would say the message overall was no firm commitment, but a willingness to act again if needed, and a communication stance that leaned hawkishly, I would say, so likely to keep inflation expectation anchored.
How does that leave your view of the future rate path? We talked a lot last week about market pricing of a July hike versus a September hike. So how are you thinking about the rate path ahead?
So I would say in general, the meeting reinforced the idea that the ECB is not on a Fed hiking cycle, but might also not be done. So they really, try to keep the full optionality here in line with what we were expected. I think a July move is still absolutely possible. It's not the base case necessarily, but at least the ECB didn't close the door. And really everything from here will depend on how the energy shock evolves. I think if oil stays elevated and if the conflict drags on, then further hikes could make sense. But equally, if the ECB's mild scenario plays out, so meaning the conflict eases relatively soon and energy pressures fades to some extent, then there may be no need for additional tightening at all. Lagarde herself hinted at how uncertain the geopolitical backdrop was, even compared to earlier expectation, and I think that's particularly important in the current context. So I think where we land is something perhaps quite balanced here. The ECB is ready to hike again, potentially fairly soon, but not committed to a sequence. So in the short term, and without a de-escalation in the Middle East, markets might not price out hikes meaningfully, but there is obviously a high degree of uncertainty around the exact timing and the delivery here.
I guess you sort of touched on it already there, but perhaps just to wrap up the ECB discussion, how does that leave your market view from here?
So I would say first perhaps commenting on how markets took this meeting specifically. I think despite the slightly hawkish tone that I've been discussing, the market reaction was actually pretty contained and even mildly constructive, which I found was interesting. I think what is happening is that we are in this environment where the ECB is talking hawkish because it has to, given the inflation risks, but it will try to act as cautiously as possible because of the uncertainty. And maybe that combination kind of anchors markets rather than push yields sharply higher. And I think it makes sense, especially since an additional 2 hikes are roughly priced in for this year already. At the same time, the ECB did insist and reinforce the idea that the energy shock could start feeding more into core inflation, and that should keep the risks of further hikes alive. So I think you end up with a market which will continue to be sensitive in the front end, will continue to react to energy headlines and ECB rhetoric and speeches in the coming weeks. And I touched on that a little bit, but I think just to make clear in terms of what markets are pricing in for upcoming meetings, we continue to think that while consensus continues to favor September as the more likely timing for a follow-up hike, July cannot be ruled out, particularly if geopolitical conditions fail to improve or deteriorate any further. It would make sense for the ECB to opt to move earlier to signal responsiveness and protect its credibility, if we don't get a de-escalation in the Middle East.
Thanks, Oriane. So, Ian, we're also setting up for the Fed next week. But maybe before we get on to our expectations from the meeting itself, it's probably worth just chatting through some of the data that we've had this week. We've had, I think since we last recorded, we've had NFPs, we've had CPI, we obviously had PPI today, and some other bits and pieces. But what's generally your takeaway from the messages that we've got from the data this week?
Sure, thanks, Imogen. Yeah, I'll start with last Friday, actually, with the jobs data, because we had what was a very strong report. I mean, the jobs added in May nearly doubled consensus expectations, and we had some pretty strong revisions as well. The 2-month revision was boosted over 90K jobs. So this actually pushed up the moving average, the 3-month moving average in payrolls, which is closely watched, up to about 188,000. Payrolls gains through 2025 averaged just 10,000 a month after revision. So in a sense, this report was pretty narrative changing. I think that's how markets interpreted it. In the immediate aftermath, we saw some pretty significant bear flattening on the Treasury curve. We had the 2-year point sell off about 12, 13 basis points, just as traders sort of added to their expectations for a potential Fed hike later this year. And indeed, one was and is priced in now. So just, I guess, thinking of it more broadly, the report on Friday does imply that a delicate labor market need not be, I think, the primary source of concern, not necessarily not a concern, but not the primary source of concern. And, I think that's important because it perhaps widens their scope, which was already widening, to address the inflation problem. This has sort of been the shift that we've seen in recent weeks and months. We've already heard from some of the Fed members, including Governor Waller. A few weeks ago, he came out in support of removing the Fed's easing bias due to sort of the stability he sees in the labor market and the fact that, as you mentioned, the conflict in Iran doesn't look close to a resolution anytime soon. But he did cite, stability in the labor market as one of the reasons to remove the easing bias. And this type of report certainly supports that. I will say, for all the strength in the top line reading, we also saw an unemployment rate down or hold at 4.3%, so I'd consider that strong. But there were some dovish signs below the surface. I think it's come up on this podcast. We've been watching very closely wage data in recent months, just for any signs if this sort of robust or at least firm labor market is going to act as a tailwind to inflation from the demand side. It's pretty commonly accepted, including on our end, that higher inflation recently is supply-led via the oil shock and the conflict in Iran. The question for that is how pervasive it will be. And the wage data, I think we can look at and ask ourselves the question, in addition to the supply side, are we going to see some tailwinds, from the demand side, from a strong labor market? But, the wage data again showed us that payroll income is falling, and it has over the last couple months. Real wages are falling. So if I put on, my dovish glasses to look at this report, it doesn't necessarily imply that the labor market is bringing these additional inflation pressures, at least for right now. So Fed members could look at this point and say, hey, look, the labor market is strong, but it's not, making our current problem worse. And perhaps that they interpret that as having a little bit more time to let the supply side picture play through. So that was a lot on the labor market, but let me just touch real quick on the inflation side, which we got this week. I'd say the data was pretty good, as in less inflationary than expected. We did have energy costs again driving a jump in headline CPI well above 4%, up to 4.2%, so highest mark in a couple of years. But core inflation, is a little bit more tame than I think anticipated, and is still, hanging right below 3%. And the important interpretation here, and our economists do this work, is that they point out that there aren't clear signs of imminent spillover risk due to the energy shock into the core components. And they even say that if energy prices hold sort of where we are right now at these levels of crude oil around $90 a barrel, we could actually see the next print in June be mostly devoid of any impact from higher energy prices. And I guess that's the positive. The negative is that core PC is still running at what we expect to be 3.3, 3.4%. But so that's a clear risk. And just to put a wrapper on this, I think across jobs and across inflation, there's some good, some bad, or some hawkish, some dovish, and I think markets are continue to trade, I think, with a little hesitation and a little bit of indecision, just because there's not clear conviction, I think, to be garnered from either of those sets of economic data.
Thank you. So in light of all of that, then, how are you taking the kind of data backdrop, what we know about the way that events have unfolded in the Middle East, plus you add on a new Fed chair? How are you thinking about the Federal Reserve's meeting next week?
Yeah, it's tough because we have all this net new information and data, but we don't have a good game plan for how to interpret it. And as you mentioned, it's mainly because this will be the first meeting with, new Fed Chair Warsh being at the helm. We know that he's intent on leading a reform-oriented Fed. He's been very clear about that. But we just don't know what those, reforms will look like in the early stages. We haven't even heard from him in any meaningful way since he was confirmed into office. But I think we can just broadly expect this meeting to be, a break from what we've become accustomed to under Powell. I think that the Fed's statement could be trimmed down pretty significantly and just really focus on the policy action. And I should have mentioned, we expect no change at this meeting, and markets do as well. But we could see some trimming of the statements because Warsh does have full control over crafting that message, and then Fed members can agree or disagree with it. But this might be the one point where he can exert some of his direct and early control over the meeting and potentially even maintain, the easing bias, which, as I mentioned, some Fed members have been looking to move away from. But I think broadly across this meeting, we also expect less focus on forward guidance. He's been a vocal critic of this. Now, does this mean we don't get a summary of economic projections and we don't get a dot plot? We don't think so, but it's not like the dot plot was a really popular Fed tool to begin with among, all members. But if it is released, I don't think Warsh would be a participant. He probably wouldn't put a dot down. He'd probably just abstain as someone who doesn't find that type of signaling particularly useful. And then in other parts of the meetings, I personally think he's going to use this meeting to find a consensus where he can, not come out of the gate firing into, pure controversy. I think he's going to want to find ground with, the governors and presidents where possible, sort of buy himself a little bit more time to exert greater control over the coming meetings in July and September, and not really cause any fireworks. That's, I think, one of my main expectations. And then the final part of the meeting, which is the press conference, he is expected to do this. He did tell Congress he would very likely participate. So, this is probably the main opportunity for him to frame how he's interpreting the current economy, interpreting the data we just discussed. And I think markets will be looking at that moment for, the next signal for how we can trade these next few months, potentially into the end of the year as far as the Fed goes. But markets just generally have been quiet it's felt really volatile because of the headline ping pong that you mentioned, but the markets have generally been pretty subdued, and I think they're waiting for this milestone like we are. And I guess I'll just share our view, which hasn't necessarily changed much in recent months. It continues to be that Warsh is going to try to steer this committee to focusing on keeping growth high with a lesser focus on perhaps targeting a strict 2% inflation target. And if we get any inclination of that at this meeting, we continue to think that spells out a steeper curve. There is a lot of hawkish action or hawkish Fed priced in right now. I think probably even too much, especially for a new chair that has been on the dovish end of the spectrum over the last couple months and said that he would get creative with making changes at the Fed. So we'll just look to see if some of that hawkish pricing comes up. Our core view remains that Warsh will be able to sort of steer the committee and extract 75 basis points of rate cuts. The first of which could begin in December. So that's what we're watching. But Imogen, we also have the Bank of England next week. So I'm just wondering, what are you watching there?
Thanks, Ian. I mean, after you've been through all of that, I think it's fair to say that the Bank of England meeting is probably going to be a little bit less interesting. We don't have a new governor to contend with. We sort of understand, we think, their reaction function and the way that the Monetary Policy Committee are inclined to vote. And of course, it's not a quarterly meeting with no updated projections. So there's not much for us to go on. We'll be watching closely any changes to the guidance and any changes on the vote. So on the guidance, of course, there was quite a big overhaul at the last meeting. We had the introduction of the scenario analysis. And whilst we've had plenty of data since the last meeting, it's broadly been quite neutral from a monetary policy perspective. We had that downside surprise on inflation, but a lot of that was about sort of temporary and in some instances backward looking, like the energy components with the energy price cap. And so we've also had the labour market data again, that was a little bit softer, but some caveats there with regard to some of the falls on the PAYE data that we expect to be potentially revised away. And then against all of that, we've had stronger than expected GDP data. So taking all of that on balance, it probably doesn't seem like there's enough to warrant any update in the guidance, given that there was just such a big overhaul just 6 weeks ago. And it doesn't sound, certainly from the centrist voters that we've heard from, it's not obvious that they're kind of leaning any more hawkishly, and there would be much impetus to change that guidance. So really it just leaves the vote as the key focus. At the last meeting we had an 8-1 vote, so Hugh Pill, the chief economist, was the lone dissenter. The coalition of one, as he described himself when he came in to talk to us. Quick plug, there was a recording of that on the podcast if you want to listen to it. A little bit outdated now, but nonetheless. So we would expect him to vote for a rate hike again. And it's quite possible, probably our base case really, that Megan Green also joins Hugh Pill. So we get a 7-2 vote this time around. There is risk of additional dissent, maybe Catherine Mann. And it's also possible that Megan Green, although she was starting to sound a little bit more hawkish in her comments recently, perhaps she just waits until the July meeting to actually vote for a rate hike. But yeah, at the margin, our base case is for a slightly more hawkish outturn based really solely around the vote.
And just from the market's perspective, is any of that going to matter?
It really shouldn't be that much more than a placeholder meeting. I guess the interesting point, a little bit like you were talking about for the Fed and also what Oriane was saying with regard to the ECB, is not really what they deliver at next week's meeting, but I think it's how that sets us up for the meetings beyond that. And particularly I'm thinking about July, where the market is actually pretty much 50-50 on whether there is a hike or not. So the risk really is that because it's so finely balanced, the market just overinterprets any kind of marginal signal in either direction in terms of the change in communication or the change in the vote for what it means for July or even hikes beyond that. So you kind of risk getting an outsized market reaction on not very much new news. Like I say, the base case is for a 7-2 vote. That in and of itself probably isn't that market moving because Green has been a little bit more hawkish in her comments of late, if it is Green that joins Pill for a dissenting vote. If we are to see 6-3 with Catherine Mann dissenting as well, I think that would be quite market moving. I think you would see July odds of a hike increase somewhere closer to probably 80% from the current kind of 50%. Although we have tended to have quite a hawkish view, certainly versus client consensus out of the conversations that we've been having, I would push back a little bit against that, only in the sense that, you know, the MPC at the BOE, it's quite different from the ECB, for example. It's not a consensus building committee. It is really one member, one vote. And so it's somewhat irrelevant how hawkish those fringe voters are. You know, Hugh Pill doubling down on its hawkishness, or even Catherine Mann joining Green and Pill to vote for a hike, is sort of irrelevant. It doesn't get us that much closer to actually a rate hike being delivered. What you need is the likes of Bailey, the likes of Ramsden voting for a rate hike to sort of get it over the line. And like I said before, it doesn't feel like they're that much closer, or certainly not in a rush to be voting for a rate hike anytime soon. Certainly not as soon as June, and probably not as soon as July as it stands either. So we're sort of comfortable with our ongoing call that rate hikes are likely to be delivered, but delivered later rather than sooner, perhaps Q3, but perhaps even more likely in Q4. So if the market does overinterpret any signal in the vote too hawkishly, I would kind of look to fade that. And I don't think that July is particularly likely.
I think that makes sense. But how about the balance sheet? Are you watching anything?
Yes and no. I mean, the BOE vote annually on the pace of QT for the 12 months from October in September. So we're not there yet. And like I said earlier, it's not one of the quarterly meetings of the press conference. So there's no opportunity for any questions to arise on the balance sheet or on the pace of QT. However, I will be watching the market participant survey, which is published alongside the decision, because they will include what market participants think about the pace of QT in the quarter ahead. In last month's survey, it showed strong consensus was for a step down in the pace of QT. So currently the Bank of England shrink the balance sheet at a pace of 70 billion this year. And consensus seemed to be around that number shrinking to just 50 billion, which, given the way that the natural runoff of the portfolio evolves, that would imply a relatively similar pace of sales. I think I talked about this a little bit last week, so I won't go into too much detail. But the reason I'll be watching that closely is because having thought about it and looked into the detail a bit more, it seems that we now have a bit of a counter consensus view, or I think there is no reason why the Bank of England would feel necessarily encouraged to step down the pace of QT. That's not to say I think it's the right thing to do, but on the Bank of England's framework, with regard to the fact that they don't think that it's kind of having an outsized impact on the market, with regards to the fact that they've managed to drain reserves without having significant cheapening in repo, for example, or in money market instruments, that mean that their repo facilities are working as intended, even as we close in on that kind of equilibrium level of reserves in the system. I think that means that QT kind of continue at the current pace. But that's probably enough on the BOE. Let's have a quick think about anything else that we'll be watching. Ian, is there anything that, away from the Fed, I guess, that you'll be thinking about over the next week?
Yeah, well, like you said, the Fed is the very big one. But if I had to scrounge around a bit, I am watching potential reconciliation bill again. Congress just passed the 70 billion reconciliation bill this week to fund ICE and Border Patrol. And, you know, as we sort of expected, the passage of that bill, not necessarily that important from a budget perspective, but important because it opens up the next reconciliation bill possibility. And indeed, President Trump already came out with a tweet today saying just that. He's calling for another 350 billion. This one focused mostly on the military and increasing the budget there. So just something to keep an eye on from the fiscal side if we get any more news with respect to reconciliation.
That links nicely, I guess, into what we'll be thinking about. It is, of course, the Makerfield by-election next week. It feels like a very long-awaited by-election that we don't normally wait, or certainly doesn't garner as much market attention by-elections don't usually in the UK. But of course, it's important because it will potentially dictate the outcome for any leadership challenge in the UK. If Andy Burnham does win, that he becomes an MP, and that enables him to launch a leadership challenge, as he has said now that he will if he's victorious. There remains a bit of uncertainty around whether that will actually, whether there will actually be a contest at all, which leaves I guess a timeline for any potential change in power in the UK a little bit unclear. But our working assumption at this stage, if Andy Burnham is to win, is that there will be a leadership contest over the summer, which would pave the way for a new Labour leader and a new Prime Minister in place for party conference season in September. It's obviously sort of going to be a very much watched political event in the UK. And although we have this longer term target, as listeners will know, of a sort of bearish gilt yield view, we have this 5.25% target on 10-year gilts. I'm really not expecting the results to drive us much closer to that 5.25 target than we are now. I mean, Polymarket Betfair odds are have a Burnham victory at about 85% likelihood. So, it's our view of getting to 5.25% in 10-year gilt yields is not about the market underpricing the odds of a Burnham victory in this by-election. It's about the market underpricing the fiscal risks that would be associated with any change in leadership. So I don't think that the results on Thursday are likely to be a trigger for markets moving closer to our base case in kind of accurately reflecting those risks. I think you would need to see A, a formal leadership challenge, and B, more clarity on Burnham or any other candidate's policy stance for markets to kind of more clearly consider what the fiscal implications would be. If I was to put numbers on it, I would expect that the market moves on Friday would be pretty muted in the event of a Burnham win, a couple of basis points higher potentially in yield, and perhaps a slightly larger rally if he were to lose. But that I don't expect us to reach that 5.25 level, I guess is what I'm saying on Friday. It's much more about the medium-term fiscal challenges in the UK. The extent to which the politics is likely to dominate the economics over the next couple of years for any prime minister as we near the next election, and the extent to which we're likely to see fiscal slippage certainly against the OBR's current projections, which show some fiscal tightening. And it's that sort of medium-term risk that I think the market is underpricing, not any sort of near-term risk related to the by-election. But of course, it's very much on our radar in the week ahead. We will be recording, of course, next week. We'll actually be recording before the results, but by the time listeners listen to it, they will have the results. So perhaps it's something we will come back to in subsequent episodes. But that's probably all we've got time for today. So thank you both for joining me. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.